The year 2026 has become a pivotal threshold for the global automotive industry. What was once a seamless, integrated production ecosystem spanning the 49th parallel is now the site of a high-stakes economic divorce. At the heart of this disruption are staggering figures. 210,000 American automotive jobs are currently at risk, and the average price of a new vehicle in the United States has surged by nearly $4,800. For an industry that contributes approximately 5% to the total U.S. GDP, the current supply chain fragmentation represents more than just a market correction. It is an existential crisis. As the trade war between Washington and Ottawa intensifies, the industrial landscape is being forcibly redrawn. Standing within a high-tech manufacturing hub in Ontario, Canadian Prime Minister Mark Carney recently signaled a definitive departure from the status quo. Canada has pivoted toward a safe harbor strategy, backed by billions in domestic incentives, designed to capitalize on the instability radiating from its southern neighbor. The most immediate and visible casualty of this trade war is the American household. Initially designed to protect domestic manufacturers, the aggressive tariff regime has instead acted as a massive surcharge on consumers. By late 2025, the cumulative impact of levies on raw materials, ranging from specialized steel to advanced semiconductors, added an average of $6,400 to the MSRP of new vehicles. In the burgeoning electric vehicle (EV) sector, the figures are even more alarming. Due to the high dependency on cross-border battery components and critical minerals, some EV models have seen price spikes exceeding $9,000. Average new vehicle price, 2026, surpassed $53,000, the highest in U.S. history. Entry-level EV pricing. Models that were originally marketed at $35,000 have frequently jumped to $48,000, effectively pushing clean mobility out of reach for middle-class families. Inventory lag. Dealership inventories have swelled by over 20% as potential buyers, deterred by prices and high-interest financing, choose to repair older vehicles rather than enter the new market. To understand why these costs have spiraled, one must look at the physical journey of a modern vehicle. Historically, a single car part could cross the Canada-US border 5 or 6 times before reaching the final assembly line. Under the 2026 tariff environment, each crossing triggers a new set of duties. The compounding nature of these tariffs has made domestic production an expensive misnomer. Even small tariffs on primary inputs like aluminum and glass are multiplying through the value chain. By the time a finished truck rolls off a line in Michigan, its components have been taxed at multiple stages, leading to a massive disruption of the just-in-time manufacturing models that defined the industry for 50 years. A 2026 study by a prominent manufacturing group highlighted the long-term structural danger. If the current trajectory is maintained, the U.S. auto sector could lose 18% of its total production capacity by 2030. This translates to roughly 4 million fewer vehicles being produced annually on American soil compared to pre-2024 projections. The economic ripple effects have moved rapidly from spreadsheets to factory floors. By the first quarter of 2026, the industry reported that over 38,000 automotive workers had already been furloughed or permanently laid off due to supply chain bottlenecks and declining demand. The crisis is hitting the American Midwest with surgical precision. States like Michigan, Ohio, and Indiana, the traditional backbone of the industrial economy, are seeing the gradual erosion of high-skilled, well-paid manufacturing roles. The human toll by 2030, direct job losses, projected at 210,000 manufacturing positions. Workforce impact represents more than 10% of the entire U.S. automotive workforce. Ancillary losses. For every direct manufacturing job lost, local economies in Detroit and Cleveland are seeing secondary losses in logistics, parts supply, and local services. For many of these workers, these are not just jobs. They are the foundation of local tax bases that fund education and public infrastructure. As production slows, local governments are beginning to report sharp declines in revenue, creating a secondary perfect storm of municipal instability. While Washington navigates the volatility of trade isolationism, Ottawa has positioned itself as the continental safe harbor. Under Carney's industrial strategy, Canada has successfully lured global capital away from the U.S. heartland by offering a commodity that is currently in short supply: predictability. By the midpoint of 2026, foreign direct investment, FDI, into Canada's automotive and battery sectors surged to a record 95 billion Canadian dollars. This represents nearly 4 times the total automotive investment Canada saw in the 2 decades prior to 2024. The battery pivot. Major South Korean battery manufacturers, originally eyeing expansion in the U.S. South, have shifted their focus to Ontario. They are enticed by lower energy costs, stable trade policies, and generous clean tech tax credits. New gigafactories. Canada's current construction boom is expected to create over 70,000 high-paying jobs, many of which are attracting talent that would have historically been recruited by American firms. Market share shift. Analysts predict that if current trends continue, Canada could secure up to 40% of all new automotive manufacturing investments in North America over the next 5 years. One of the most potent weapons in Canada's arsenal is its vast reserve of critical minerals. As the world shifts toward EVs, the battle for the future of mobility is being fought in the mines. Canada currently holds some of the world's largest deposits of the materials required for battery production, and unlike the US, it has invested heavily in domestic processing. By processing these minerals domestically, Canada is moving up the value chain. Manufacturers are finding that it is both cheaper and more profitable to produce EVs and batteries in Canada, where they have direct access to raw materials and clean energy infrastructure, avoiding the tariff-laden border altogether. Perhaps the most damaging long-term effect of the trade war is the change in how global investors perceive Washington. For decades, the United States was the undisputed destination for manufacturing capital due to its massive market and its legal predictability. In 2026, that reputation is fading. Companies making billion-dollar decisions about factories that must operate for 20 or 30 years are now factoring in political risk when looking at the U.S. market. The threat of overnight tariff changes or sudden shifts in trade policy has made the U.S. an unreliable partner in the eyes of several global automakers. By contrast, Canada's doubling down on openness and long-term industrial planning has made it the preferred ecosystem for the next generation of manufacturing. The trade war, initiated by the U.S. to bring back industry, has instead served as the primary catalyst for Canada's industrial renaissance. The United States now faces a steep price tag for its current trade strategy. The automotive sector, which represents the lifeblood of American industrial history, is at a crossroads. As manufacturing capacity shrinks and high-skilled labor migrates north, the U.S. risks losing its position as the continent's leader in clean mobility. The current fractures are no longer theoretical. They are manifested in the shuttered plants of the Midwest, the $53,000 price tags on dealer lots, and the multi-billion-dollar gigafactories currently rising in Ontario. The question for Washington in the coming years is not whether tariffs can protect the industry, but whether the industry can survive the protectionism. As Canada continues to solidify its role as the new heart of North American auto production, the United States may find itself in the unenviable position of playing catch-up in a race it once led. The era of industrial dominance through isolation is ending. The era of leadership through stability and strategic investment has begun.